Warren Buffett is the CEO of Berkshire Hathaway, but he started investing in stocks when he was just 11. According to Forbes, Warren Buffett is worth $82.5 billion, making him the third richest individual alive. A lot of his early investing was done in a company called Geico, which he would buy stock in at 10 cents per share. He then sold it back to the company for 90 cents, which is now worth $10. Warren Buffett has taken over 32 companies since the year 2000 and has become one of the most influential people alive today. When asked for his best investment advice, Warren responded, "When an individual with cash meets an experienced individual, that individual with experience ends up with cash, and that individual with cash leaves with experience." Warren Buffett says that experience is the ultimate key to be a successful investor. Warren Buffett is one of the best-known long-time investors, so it's not surprising people are always tuning into what he says to see how they can apply his advice to their own lives. Buffett has a wealth of advice to share with investors and aspiring investors, which we've compiled here. So pay attention to these top 10 pieces of investment advice from the man himself. And as always, you can find all useful links in the comments section below. 1. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Warren Buffett has offered up a few points here. They may seem simple, but they're actually quite complex. As an investor, your job is to make money, but one of the best ways to do that is to avoid losing it all. It's always a good idea to cut out any possible financial losses when investing. But beyond that, you should be financially responsible and make sure that these investments will eventually give you a profit. You'll want your money to work for you in the long run, not just disappear completely. This quote implies that you should look to avoid risks before getting ahead of yourself and only then think about the potential for gains. It's a different mindset from what some investors adhere to, who may focus on nothing but the highest possible upside. 2. Diversification is not always a good idea. Some good investors think that diversification is important, but Warren disagrees. He says that diversification is for people who know less about investing. Experienced investors should make decisions about stocks on a long-term basis instead. Most investors diversify their portfolios to minimize risk and maximize return. But at the same time, this reduces their ability to keep track of every event in a company's day-to-day operations. So, by diversifying, they might have a lower risk portfolio, but at the same time it means less focus on individual investments. Buffett waits for good stocks to come his way and buys them when he can. According to Buffett, when it's raining gold, put out the bucket, not the thimble. 3. Be fearful when others are greedy and be greedy only when others are fearful. Some investors believe that investing is all about numbers, but Buffett suggests that investment has a lot to do with human behavior. When we're greedy and the stock market gets too expensive, he becomes fearful and backs off. In contrast to other investors, Buffett loves to buy stocks when everyone else is running for the hills. This is because stocks become cheaper when prices go down, which means they carry less risk than when they're worth a lot more. COVID's recent plunge has been shocking, but it's also created opportunities for investors to pick up shares at deep discounts. That said, we need some stability in the market before it can bounce back. 4. Make investments that you understand. Warren Buffett is quick to point out that many people overthink things before buying, making the investment decision more complicated. He advises you to always invest in what you know and not weigh yourself down with too much information. Whenever he's looking to invest in a company, he likes to first find out how it makes its money and the main issues that impact it within 10 minutes. If he can't understand that within 10 minutes' time, then he moves on to the next company. In his opinion, it's very hard to do well in the market if you don't understand the business. He's always looking to simplify things so he can make money and doesn't waste time doing things that won't work. Most people can't pinpoint the next popular trend among teens or decide if a certain medication is going to be successful. There's just too much data for anyone to predict the future with 100% accuracy. Some things in life are unpredictable, so if you don't know what you're doing, just steer clear of investing. When it comes to them, look for safer bets. Warren Buffett once said that he would invest in only about a few hundred publicly traded companies out of 10,000 plus firms from just looking at their fundamentals. 5. If you like spending 6 to 8 hours per week working on investments, do it. If you don't, then dollar cost average into index funds. Buffett always suggests that most people invest their money in an index, rather than bother trying to pick individual stocks. If you're able to pick stocks that outperform the average professional investor, then great. But for most of us, there are too many outside factors we can't control. If you want to buy an index fund and follow the market, then buying an S&P 500 index is a good place to start. It's arguably the most popular benchmark out there. If you enjoy investing, then do it. Just know that index funds have historically outperformed most actively managed investments and that trading stocks is usually not a better idea than just holding on to them. In fact, the major advantage of using an index fund is immediate diversification. 6. Keep cash on hand. Another way to keep things safe is to always have a decent amount of cash on hand. We always maintain at least $20 billion, and usually far more, in cash equivalents, Buffett commented in the 2014 Berkshire Hathaway annual report. People might want to put their liquid cash to work and make investments. Cash, though, is to a business as oxygen is to an individual, never thought about when it is present, the only thing in mind when it is absent, Buffett said. When bills come due, only cash is legal tender. Don't leave home without it. 7. Think like an owner. Warren Buffett encourages people to think about investing as if they are the owner of a company. This gives you a fresh perspective and will influence the way you invest. Warren Buffett says that if you are going to buy a new car or bike, you will think about what it's worth. You'll think about its features and compare with other cars and bikes on the market. Then you'll figure out which one to get after reviewing all the options. Similarly, stocks should have the same view. 8. You don't get paid for activity, you only get paid for being right. There's no shortage of people who will tell you what to do with your money. But Buffett reminds investors that being an active trader and constantly switching from position to position isn't the best idea. In the investing world, it's so easy to feel like we're doing something worthwhile just by being busy, but the only question you should be asking yourself is whether your analysis was right. 9. After all, you only find out who is swimming naked when the tide goes out. Investing can be pretty easy at times. When the markets are high, it feels like you'll never want to stop buying in. But once they start getting bad, we find out who's been investing responsibly and who hasn't been preparing enough. At a few points in his investing career, Buffett has seemed out of step with the current climate. But inevitably, the environment shifts and those who once looked smart are revealed to be swimming without their trunks on. The best way to secure yourself against bear markets is to always make sure your portfolio is balanced and set up to survive a bear market. 10. Learn about money. Investing in yourself is a good idea and learning about your finances should be part of it. There are many aspects to money, and some important ones include limiting exposure and minimizing risk. Look at what Warren Buffett has to say on the importance of being knowledgeable on the topic. Risk comes from not knowing what you're doing. If you know enough about personal finance, minimizing risks and obtaining financial security will be easier. Warren Buffett says that one of the lessons he learned is to actively educate oneself in the field of finance. His partner, Charlie Munger, says that one should go to bed smarter than when they woke up. Bonus tip: there's no room to be emotional. Some people have no business owning stocks because they get so mad when the price changes, Warren Buffett noted while speaking on CNBC. If you're going to do dumb things because your stocks are going down, why own stock at all? Buffett said he believed more people would be good at investing in stocks if they were more informed on what they were actually buying. The bottom line: Buffett's investment strategy can be classified as bargain hunting. He is someone who takes a practical and down-to-earth approach to investing. Buffett has a very simplistic lifestyle that revolves around his personal values. He doesn't live in a mansion with too many cars or even take a limo to work. Value investing, while not without its critics, is something he believes in and continually pursues. But whether you support Buffett or not, the proof is in the pudding.